anybody buy a stock? Well, as we've already mentioned, and let me just reiterate it in this lovely simple illustration, buying a portion of a company means that when the company profits, so do its shareholders. Even though there's a great fluctuation in the global markets, time has proven that the markets provide a consistent return over a long period of time. In July 2010, so a few years ago now, but still a good figure, 46 trillion US dollars is the value of the world stock exchanges. That's a lot of money. Of course, the biggest market in the world is the US, followed by Tokyo, NASDAQ, which is also America, of course, and then you've got the London Stock Exchange, the value of all the companies listed there. The Dow Jones Industrial Average, one of the most followed indices, has shown significant and consistent growth over the years. And you can see how the exchanges have moved. Of course, we've had recessions, we've had down markets, we've had credit crunches, and so on. But nevertheless, over time, the stock market generates returns. And that's if you're just buying and holding. What if you're trading them using trading strategies? Then, of course, you've got the opportunity to make even more. But that being the case, what then determines the price of a stock? Well, obviously it's company's earnings, the company's profits and how much it might earn, investors' outlook regarding the company's growth potential, so supply and demand, and other factors are various financial ratios. And you'll have heard of some of these, and you're probably wondering, well, what are these financial ratios? What do these things mean? And one of the things that I want to get across to you is that they're not necessarily as complicated as we might think. I know it sounds ridiculous. These are just some of the financial ratios I'm going to cover, but there are a whole variety of financial ratios, and what I want to do is just give you an overview for now. Of course, in other videos I go into great detail so you can understand these and you can profit from them. You see, the problem is a lot of private investors don't understand these. Because they don't understand these, they don't get around to learning how to profit from them. And so what I'm going to show you is how to understand these so that you can profit from them. Let's just start off, therefore, with the left hand of the screen. And you can see three financial ratios, popular ratios. And let me explain them, because this will help you understand how we pick stocks and also what it is that the market looks for, and will make you into a better stock picker. So let's just start off with the first one, price-earnings ratio. The price-earnings ratio is probably one of the most widely used ratios in the investment community, or the PE ratio. And what it does, in simple terms, is it says what, allowing for the profits of the company, what each share is worth, basically. So it normalizes, it makes all shares in all companies pretty much the same, because what it does is it divides the number of shares in every single company there is by the earnings that that company has generated. And so it says that, for instance, if the number is 14, what that means, a P ratio of 14, means that for every share in the company, you're paying 14 times the profits that that company has generated per share. Why would you pay 14 times what that company has generated per share? Well, let me put it this way. Let's say you had a company which generated £1 million a year in profits. How much would you sell all the shares in that company for? Would you sell it for £1 million? Well, obviously not, because if it's making £1 million a year, why would you just sell that company to me, all its shares, for £1 million? You'd say, well, I'll keep hold of it because every year I make £1 million. What would you sell it for? Would you sell it for £5 million? You might say, well, I might do that, but then again, no, that seems a little bit low, because I'd hold on to it. In 5 years, I'll get it back. You might, though, sell it for 14, and that's what the PE ratio means. It means, in a way, it's a measure of how expensive the share is. If the PE ratio is low, like 5, you might think, oh, I want to buy that because I'm only buying something for 5 times its profits, which means the share price should go up because other people will want to buy into that. Whereas if it was 100, price-earnings ratio of 100, you might think, well, wait a minute, I'm paying $100 million, or my share of that, for something which is only producing £1 million a year, $1 million a year. That's not worth it. Its price is probably going to drop. That's the PE ratio. And conventionally, PE ratio is around 10, 11, 12, 13, 14 are considered relatively cheap. Anything below that is considered relatively cheap. Anything above, say, 20 starts getting into a slightly more expensive territory as a general rule. What about the return on equity ratio? Well, it indicates how much profit a company has earned in comparison to the total amount of shareholder equity on the balance sheet. So what happens here? It sounds complicated, I know. An accountant of the company will work out how much money all the shareholders have put up into the company when they bought the shares into the company at the IPO, and it'll work out how much profit it's earning. This is just another way of saying how efficient the company is at generating profits. If a company is very poor at generating profits on the equity compared to all other companies, then you might not want that. So this is a way of comparing companies with each other, like the PE ratio. And you want companies which have got, all other things being equal, a high return on equity. You want companies which are good at generating lots of profit for the same amount of shareholder funds that they have, because obviously those are efficient companies, they're profitable companies. That's as a general rule, and I'm only giving the general rules. The subtleties we'll discuss in later videos. As a general rule, return on equity, you want it to be high. What is EBIT? You might have heard of this when you watch financial news. And EBIT, earnings before interest and tax, is a measure of the number of times a company could make interest payments on its debt with its earnings before interest and tax. Sounds complicated. It's another way of saying, almost saying how much cash reserve the company has, or how much cash flow it has, a spare cash. Because the more the higher the EBIT, the greater the safety barrier. Again, all things being equal, there are subtleties to all of these things which prove exceptions to the rule. But as a general rule, the more money it has in order to finance any debt it might have, any borrowings it might have through its profits, the more safer an investment is. Now, in the next video, we'll look at the right-hand side of this. We'll look at the price-to-book ratio, dividend yields, and debt ratios. Again, generalizations of how we value companies and what makes them attractive and why these ratios are all important. And I've only picked a few here, but that'll be in the next video.